I'd love you to talk through this percentage of trace eligible IG bond issues at a 52-week low. How does the tariff pause relate to what we're seeing here on the chart?
Yep. So remember 2 weeks ago, it was the last time Cameron and I were together on the show. We talked about, all right, April 2nd was Liberation Day. And then for the next week, 5 trading sessions, it just, turned into essentially absolute panic and pandemonium. I was in equity markets, but it was also translating into fixed income and credit. So remember what we saw, yields were selling off. Um, and on April 9th, we got the retreat, if you will, from the Donald Trump X account. I don't know if he launched or posted it on his Truth Social first, but it was the walking back of the tariffs from, here's the across the board. He's like, we're going to do, it's 10% across the board and a 90-day delay. And on that show, it would have been April 10th. We did a weekly roundup. We called for, hey, this was actually the bell ringing, right? The boxing match analogy. Round one, saved by the bell. It's over. There's a violent, tough week for pretty much all financial assets. But that marked the end of it, right? Round one. And that's really, I was looking for a chart on how do I communicate this. Like when you're actually active in the bond market on the trading platforms with other institutional managers or broker dealers, all of these players who are basically just the liquidity and credit. What was happening was the liquidity was just backing away. And the best metric I can come up with to show you is not yields, because yields just show you the print on the tape where things traded. How do you come up with a metric to summarize when liquidity is retreating, like across the board on the entire fixed
Like the
income
market
complex?
left almost for everything.
Yeah, and so if you're looking at all the investment grade bond issues, and there's something like 10, 13,000, something about like that, of different bonds that go into the Bloomberg US Aggregate Index. And then if you look at other investment grade rated bonds by, the big ratings agencies, um, it'd be even more than that, right? And so the liquidity hits anything and everything that is a bond or QSIP or, whatever identifier you want to use to count these things. But what will happen in a state of kind of panic, something's going on big in the liquidity complex, a good metric to look at is the percentage of of the entire universe of investment grade bonds and how many of them are trading at a 52-week low, right? It's a downtrend in price. And you're always going to have some, right? Just idiosyncratic credits, individual companies, can post a 52-week low if their, business prospects or, decisions aren't going the way the market wants them to. So you'll always have some 52-week lows, but when everybody is having a 52-week low, that's a signal of the state of the overall conditions in the entire complex. And so when you look at April 9th, that was the peak. If you look in the cycle, and this chart goes back to 2005 when FINRA started publishing this data on trace eligible bonds. What does trace eligible means? It just means when there's a trade in the dealer oriented bond market, the SEC registered broker dealer is responsible for reporting the price and volume that the trade took place at to this trace reporting data service. I think they have 15 minutes to get their quotes in. And it just depends on the specific classification and categories of bonds. But by and large, you'll know on these bonds, you actually have a blotter publicly of where these bonds trade, because bonds are different in terms of the way they trade than the equity markets, which trade on an exchange, a centralized exchange basis where you got, market makers, broker dealers, they're all kind of reporting into this complex, this web of like 14, ish, liquidity exchanges, right? And so those trade, in a centralized fashions, and you see the entire order book, or you can see the entire order book, everything that's not in a dark pool, right? You can see price, volume, and the prints as they happen. The bond market is different. It's not an exchange market. It's a dealer-based market. There's no centralized exchange that these bonds trade on. If you're buying a bond, you're trading it with a dealer counterparty. And for a lot of bonds, U.S. Treasuries work this way. They're not actually like centralized into a reported feed of where did price and volume get struck at for a given trade, right? So for FINRA, they launched this TRACE initiative. It's been over, 2 decades ago at this point. But for corporate bonds, muni bonds, some other categories of bonds now, you'll see as trades take place, these usually have pretty big size. A typical bond trade is going to be $250,000 or more would be a round lot or a tradable lot. But they're gonna be big players, big balance sheets, either an asset manager, an institution, trading with, typically it'll be a dealer, and the dealer reports where those prices are taking place. Sometimes, like when liquidity backs away, not even all of the bonds, some bonds won't even trade, right, out of those 10,000 plus, because there is no liquidity, right? So you may not even be able to pick up the fact that liquidity was dropping away because the trades, it's kind of like that diagram of the Royal Air Force in World War II, the planes that come back, right? And it's like, we should reinforce those spots. And I forget who it was, but the statistician came up with the Bayesian approach. He's like, no. What you actually want to reinforce is the areas you don't see, because those are the critical areas that if the plane gets shot there, it goes down. Kind of similar analogy in bond world, like you may not see trades even taking place. Like some bonds, when liquidity backs away, you can't trade them unless the actual price to get a bid would be so low that the other side of the trade doesn't want to execute you, and the trade just doesn't happen. But point is, overall, when you start seeing a high share of the entire investment grade bond universe of outstanding issues start trading at 52-week lows, that's a sign that something like the liquidity conditions are drying up. So my point here, for April 9th, we called this 2 weeks ago on April 10th. We said that was probably the lull. That's the bell for round one. That's literally what we've seen. So you get a big spike. About 25% of all QSIPs printed a 52-week low on a single day, and then we saw a retreat. And so I'm active on the screen in like the all-to-all trading platforms. We're responding to liquidity requests. We can be a liquidity maker for our accounts. And, those days, that week from Liberation Day to, it was even into like April, like middle of last week, so which would have been like April 17th. You were seeing some bonds trade at still like fire sale prices, right? But that in the last 3 days, especially this week, like that's all shored up. Yields are coming in, tightening up. You're not seeing bonds just being puked out, on the street. That is very atypical for kind of time periods that are not end of quarter. So my point here, the bond markets, fixed income, credit, ever since that tweet came out on April 9th, we've just continued to firm up. Now, do you expect the choppy sea, like the easing and the choppy waters, to just continue and assume like, hey, sun's out, waters are calm, everything's good again? I don't think that's the case here. I think it's going to be a pause, but we still have, it was a 90-day delay, and we've talked about this, like that time's up right with the 4th of July weekend. So as we start burning off the fuse, and come into that date, look for that to be a forcing function for like what's the next chapter or the next round have in store. But for now, conditions in the bond market, yields are coming in. Fire sale pricing isn't really happening anymore. Liquidity coming in. You've had issuers this week like Walmart came like post Q1 earnings are in, and now your issuers are coming back in to tap the capital markets. And this week we saw some names, household names like Walmart, like blue chips like Walmart, State Street, New York Life, Amex, etc. So the window is really back open up again. So that's kind of the overall summary that settling down kind of continues. This may go on for weeks, maybe a couple months, but I am by no means operating under the assumption that the broader chapter is over. And if you looked at prior episodes where we see the kind of the spike where everything hits a few 52 or a large proportion of bonds hit a 52-week low all at once. Right now we don't know what's in front of us, but in prior episodes, so you look at those other episodes where we got that red line and when do we cross over? A lot of times it'll be, one spike and come back down. So everything from like post 2008 up until 2022. 2022 is a different version of this. I'll get into that in a second. But what you'd see is just a surge and then it'd come back down, right? That's kind of the episode of how the system can restabilize in a world where, hey, the Fed's willing to come in with QE. We can just, hold rates low, hold rates at zero, or once we got into 2017, 2018, 2019, like we could cut rates, give some easing to the system. Time will tell, like what's in front of us in the next few quarters will tell how much things have changed, because, in the 2010s, that may have been a different environment where we get these, fires and they're immediately put out. But, you see that COVID line in 2020, just a immediate spike and then the fire is doused right away. 2022, though, was a different story where we saw rates want to come up across the board secularly, and we just saw, all bonds adjusting to the rising interest rates, and everything was just, there were elevated 52-week lows being hit for several quarters in a row, and it looked totally different than what we were used to from the 2008 to 2020 landscape. So my point there, that was an environment where interest rates wanted to stay high or wanted to be higher and trend up alongside secular inflation, rising costs, etc. So I think it's going to be an interesting kind of watch these next few months to see what happens with this specific tariff situation, these negotiations. If they behave more like what it looks like the decade of the 2020s will look like if we take like that little window from 2021 to 2023 as our guide, or if you want to take the variant perception that, hey, this one will be short-lived, kind of a once in a decade moment, or once in a every few years type of moment, trading day we got on April 9th, and things will quickly settle back in. I'd say we're going to find out, right? If I had to lean towards one perspective, I'd say be careful, because from my point of view, this looks like a higher inflationary environment. Interest rates want to rise. There's pressure on the currencies, pressure on central banks, pressure on the fiscal situation. So this one's, play it carefully. Don't count on a Fed or a central bank who's always going to be there to give you the put and put the fire out with someone else's balance sheet.